Okay, so the last part of this reading, we've got to actually dive into a little bit more. I want to evaluate our trade execution. So again, as you see, we talked a lot about terms going through the section. Then we actually dealt a long time with the implementation shortfall and some of the strategies and methods that we can use. And now we want to take a look at, well, how did we actually do in regards to execution? And again, I want you to always think about the benchmark is really what's going to decide, are you successful? If you're a big football fan like I am, if you say, hey, Texas A&M scored 35 points, well, did they win or lose against, basically against Auburn or Alabama, whoever they may be playing? Well, the issue is you have to compare them against the right benchmark, and then you can figure out, hey, did they win or they lose? It's the same thing here. If we're going to do any type of evaluation, we've got to be clear what the right benchmark is, okay? So this trade cost analysis, this is going to be vital for portfolio managers. I want to know, how effective is my brokerage team? Are we using good algorithms? Are our strategies working? You know, it's hard to beat the market. I need every ounce of support that I can get, and I don't need to penalize myself and make it even harder. So costs are going to be evaluated versus some specified benchmark. Again, you can't just say, hey, I earned 14% rate of return. Well, is that good or bad? I don't know until you compare it to the right benchmark. And again, this benchmark is going to vary depending on the objectives of the portfolio manager and the nature of the order. There are different strategies. They have different tools and techniques, just like there are different securities that are used for different things. There are different trading strategies that are used for different things, and we want to evaluate how well did they work. Okay, so what are some typical benchmark prices that we can use? Well, we can use a rival price. You know, we saw that in implementation shortfall. VWAP, TWAP. We could use a closing market price. We could use opening market price. There's an endless number of benchmarks that we can do. But the other thing that I want you to keep in mind, we may have to use more than one relevant benchmark if the strategy has several objectives. So again, this gets a little bit messy. This becomes complex. But the simple part of it is, as soon as we can agree on the appropriate benchmark, then we know how to analyze and evaluate these executions. Okay, so always keep this in mind. I love this point, and I'm so glad it's in the material to help you. So buyers incur cost if they execute trades above the relevant benchmark prices, and sellers incur cost if they execute trades below their relevant prices, okay? Their benchmark prices. So always keep this in mind. This would be a great flashcard that I would carry with me as I'm going through this material. Okay, so let's go into some more formulas, some ways that we can make some calculations. So trade costs are going to be calculated such that a positive value represents underperformance against whatever the benchmark is that we're using. So a general formula, this is absolutely a formula that I would like for you to know. In fact, I'd like you to know all four of the formulas that I'm going to go over with you today. So we can take the absolute cost, remember the side. If we're buying, we're going to say it's +1 that we'll put in the formula. If we're selling, it's going to be a negative. And why? Because again, going back to here, buyers incur costs if they execute trades above the relevant benchmark, and sellers are going to incur costs if they execute trades below the relative benchmark prices. All we're doing is mathematically building what we're talking about. Okay, so we take a look at this absolute cost. It's the side. Remember the +1 or -1, depending on if you're a buyer or sell. You've got our friend execution price is back. Our benchmark price, again, the appropriate benchmark price is back. And now we're using number of shares actually executed. if we're going to look at trade execution, we need to figure out, did the shares actually execute? And that's what we're going to use to evaluate this. Okay, now these costs, just like with implementation shortfall, we can actually calculate this using basis points. And that's typically, again, how they're going to be expressed. So we're going to take the side times the executed price minus the relative benchmark price divided by that benchmark price. And then again, to convert this to basis points, we're going to multiply by 10,000. Okay, and again, EP is the execution price, BP is the benchmark price, whatever it is that we're using as the benchmark. Okay, so let's give you an example. Got a portfolio manager, he's executing a buy. Ooh, okay, it's a buy. So right off the bat, I know side is equal to +1 in our formula. Now, the portfolio manager purchases, so his executed price is $25.50, and the closing price that we're using, the relative benchmark for that, we're using the closing price as the benchmark, is $25.60. Okay, so this is a buy order. I executed at $25.50. The benchmark is $25.60. Sounds like I bought below the market. This should be a benefit to me, but let's see if it works out that way. Okay, so because we have trade, we're going into trade costs, we know that this is a buy order. The side is 1. So what do we see? We go back to our absolute cost formula. We've got the +1 that we're putting in for the side. We've got $25.50, which is our execution price. We've got our benchmark price at $25.60, and voila, just like we expected. We actually purchased below the benchmark. This is a positive. So basis points, if we take that and convert the 10 cents over $25.60, we get negative 39.1 basis points. And remember, a negative sign just indicates that the trader actually added value. A negative cost is a benefit. Okay, so again, I love that we put these problems in because these are things you might not think about that might surprise you on the exam. This shouldn't surprise you. Now you've been exposed to both positive, negatives, buys and sells. A negative cost is a benefit. A positive cost is not a benefit. Okay, so make sure you go through these, keep working at it. Okay, so the buy trade, and again, we saw this when we were putting together the problem. The buy trade was executed below the benchmark price. So remember, I bought low. Awesome. So from a trading perspective, I'm pretty happy. Okay, so regardless of the skill of the trader, we now have to make this more realistic. Buying orders in a rising market or selling orders in a falling market will incur positive trading cost due to adverse price movements. So what does this mean? We've got to take the market effects out in order to really represent and get a true representation of did this trade actually add value or not. So we have to remove this market movement on trade cost. And how we're going to do that is by using market adjusted cost. Okay, so what again is this doing? It subtracts the index cost, and we're going to justify this, or should say adjust this with the securities beta. So basically, we just want to ensure that it's set up properly and everyone's being properly allocated with success or failure that they earned. So the trader is not penalized or rewarded for general market movements over the trade horizon, something they had nothing to do with. So the index cost is going to be a representation of those costs due to the general market movements. Now let me show you how to calculate this. So the index cost, again in basis points, our friend side is back. We've got the index volume weighted average price minus the index arrival price over the index arrival price. And again, because we want to convert this into basis points, we're going to multiply by 10,000. Okay, so this gives us the index cost basis point. but ultimately we want the market adjusted cost in basis points. So what does that mean? Well, let's look at the formula. First of all, we're going to have to calculate the arrival cost in basis points. Hopefully they give that to you, but if they don't, you might have to calculate it. What is this arrival cost? It's the cost of the trade based on the arrival price benchmark. Okay, we're using beta of that security, and then the index cost, that was this last formula. Remember, we showed you how to calculate index cost. Well, now you're going to have to put it in here in the formula. So in order to use market adjusted cost, we're going to have to calculate the arrival cost in basis points. We're going to subtract from that the beta times the index cost that we just showed you the formula for. So again, make sure you understand this formula. We can't reward or penalize traders by moves from the market that they had nothing to do with. Okay, so let's dive into another problem. So what do we have here? I've got a trader who submits a buy order when the security price is $10 euro and the relevant index price is 3,500. So let's make sure that we're comfortable with the terminology. We've got a decision price is 10. We've got the relevant index price at the time of the order is 3,500. The order is executed over the next hour at an average price of 10.15. So that's the executed price is 10.15. Now VWAP for the index over this period is 3,507. So look, the market moved. It went from 3,500 to 3,507, and we've got a beta of 1.5. So we want to calculate the market adjusted cost of this trade. So remember, market adjusted cost of this trade, we need an arrival cost. Then we're going to subtract the beta, what they gave us, and then we have to multiply that by the index cost that we have to actually calculate. Okay, so let's jump in and do this. So because the order is a buy, we know the side is 1. So the index cost in basis points, how are we going to deal with this? Well, there's 1, 3,507. That was the volume weighted average price of the index. Then starting was 3,500 over 3,500. We're going to multiply that by 10,000 to convert it to basis points. So for the index cost, we get 20 basis points. Okay, we're not quite done yet. We're going to have to do a little bit more. Now we need to figure out the arrival cost in basis points. Okay, so again, side is at 1. 10.15 was that executed price that we had. And remember, $10 was the decision price. Okay, and then we're going to multiply that again, or divide that by the decision price. And again, we're going to multiply by 10,000 in order to convert this to basis points. We come up with 150 basis points. So remember our market adjusted formula. So it's going to be the arrival cost in basis points minus the beta times the index cost in basis points. Okay, so that's all we're doing here. Arrival cost is 150. It's right here. We're going to subtract from that the beta of 1.5 and our index cost, which was 20 basis points, and we come up with our market adjusted cost at 120 basis points. I know this is a lot of work for just a few points, but again, every point matters, and you can do this. There are not that many formulas in the trade section, and I want you to know all 4 that we've just covered. You're likely to need all 4 of them, or at least a portion of some of them on the exam. Okay, so let's look at added value. So we can actually play around with benchmarks. What if we use a nice trading algorithm or a new trading program that we have, And I can use a model that incorporates key trade cost variables. Maybe it factors in order size or liquidity or some other factor. So if a trade executes less than this pre-trade cost estimate that we are expecting, then the trader added value. So again, we're just moving around benchmarks. And there's no right answer. The firm can actually decide whatever benchmark that they want to analyze against. Okay, so more formally, same process that we've been doing. So an added value in basis points is just going to be the arrival cost in basis points minus the estimated pre-trade cost that our model provided us. So again, in the previous example, the arrival cost of the trade was 150 basis points. If the pre-trade cost estimate was 160 basis points, well, actually, the added value is negative 10 basis points. So again, we can move around these basis points, these models, and we can help them get more information and help us zero in on what we think is important. So to be able to come up with an estimate from using some updated models or maybe some changes that we did, and then actually be able to calculate, okay, well, this is what we thought we were going to get. What did we actually get? So again, we want to evaluate, are we doing a good job in our trade executions? Okay, and again, in this example, a negative cost is a benefit. So we brought up a number of examples that show negative cost. It's not a mistake, it just means that it's a benefit. Don't let that surprise you on the exam. Okay, so now we have to get into trade governance. So it's both a good practice and it's usually required by regulation. So the fact that it's required by regulation, you got to do it anyway. So the asset manager needs a formal written trade policy that clearly spells out all of the trade procedures. So what do we find? Well, the trade policies are going to have 4 key areas. First of all, which I think is a huge question, what is best execution? Is it just choosing the company that has the lowest cost, the lowest explicit cost? No, it's not. And that's a mistake that many people make, many portfolios and small firms make. You can't make that mistake. Best execution doesn't mean cheapest. It might mean something else. Okay, factors that determine the optimal trading approach, list of approved brokers and execution venues. This is critical, and this has to be updated. I did this for my firm for a number of years. It isn't a lot of work to keep track. What if one of the brokers or team or traders that you use, what if they had a major trade crisis? Or what if somebody was a crook and committed some type of felony? You need to keep up on these things, and you've got to do your due diligence. And that's where we talk about how are you going to monitor these processes. So again, all of these things are discussed in a good trade policy. Okay, so I want to spend some time on best execution. This seems to confuse a lot of candidates and certainly confuses a lot of non-finance professionals. So best execution, it's a general term. It's used by regulators to describe the duty of the asset manager to seek the best possible results for the clients when trading their assets. Okay, seek best possible results. Remember, it's not just explicit cost that we're worried about. We're worried about the implicit costs also. Okay, so the trade policy should define what is best execution, and it better be within regulatory framework. Okay, so what factors generally determine best execution? Well, execution price, absolutely, that's part of it. Trading cost, sure, that's part of it. It's not the whole thing. The speed and likelihood of execution and settlement. This is critical. If you have the lowest trading cost, but you never execute any of my trades, who cares that you're cheaper? Order size and liquidity. How well do you do with big trades? How good at you are filling orders in low liquidity markets? And then this is, again, another key area. I want to know how good you are if I absolutely have an urgent trade that needs to get filled. Can you do it? Okay, so best execution does not, let me repeat that, does not simply mean seeking the best price of trading at the lowest cost. Absolutely, we talked about this. It's only one component, trading cost, one component, not everything. Okay, so let me give you an example. Let's say I'm a portfolio manager, I have a lot of shares in a firm, and I just now realize that this firm is going to go bankrupt. So it would likely achieve better results if I would rather sell this block with a trusted dealer at a significantly discounted price, even though there were higher bids for small quantities at other execution-lit venues. Now, this could be justified as best execution because the execution risk for adverse market movements was so high, and also this could have shown information leakage. If I kept hitting the bids, this would show up on computers and technology and algorithms, and I would end up selling in a market that's falling, which isn't going to help me. Okay, so what are some factors that determine an optimal execution approach? So the trade policy needs to communicate urgency and size of the order, liquidity of the security, and characteristics of available execution venues. Okay, some more things I want to focus on. I want to know the investment strategy objectives, and then the other area that I want to zero in is what is the reason for the trade? Okay, these factors need to reflect the relevant regulations and market trading conventions for not just one asset class that's used by the portfolio manager, but for all different asset classes used by the portfolio manager. So again, factors that determine the optimal execution approach, there are a lot of things here. What I would do for the exam, I'd feel comfortable maybe grabbing 2 or 3 of these things and be able to offer a little explanation about why they belong in an optimal execution approach. Okay, soft dollar arrangements covered extensively in ethics in level 1 and level 2, and they're back in level 3 again. Arrangements where a manager gets paid for goods and services using rebates from client commissions offered by using that broker. Okay, so this may jeopardize best execution if the manager uses these soft dollars for their own benefit. Be comfortable with soft dollars. Go back and review soft dollars and code and standards. Make sure you're comfortable with soft dollars. Okay, this list of eligible brokers, I did this for a while for my firm back when I was in the industry, and it is a lot of work. It is time consuming, and honestly, sometimes it gets hard to figure out, especially if there is an incident, what actually happened at that firm. So your trade policy should include a list of approved brokers with the description of the process used to create it. What we did, and what the CFA Institute tells you should do as well, it makes sense. You should have a best execution monitoring committee. So the onus is not just on one person, it's on a whole team. And this is going to consist of basically portfolio execution, compliance, risk personnel, and ultimately they're responsible for maintaining, updating, and distributing this list to any parties that are involved in trade execution. So I can't stress enough, a best execution monitoring committee is a fantastic tool, and you absolutely I would recommend that you guys consider this. Okay, still in trade governance, what are some general principles for approval? So how do you get on our list? Well, you better have high quality of services. You better be competitive. You better have financial standability, and I would add, you better have a good reputation for ethical behavior, because if you don't, I don't want to work with you. I also need adequate settlement facilities, and I need you to be competitive. I don't need you to be the lowest explicit cost, but you can't be the most expensive either unless you add some other value. Okay, and the other thing that I want to see a willingness to commit capital to principal trades when I need them for less liquid securities. For me, this is key. Okay, now what about a process for monitoring execution arrangements? The approved broker list should be constantly monitored, and I want to key in here for reputational issues. Or what if you're always making trades wrong? There's a lot of errors that you're making. And I also want to keep an eye on any criminal activities that you might be doing, and I want to make sure that your firm is financially stable. So I need these things to be checked, and I need these things to constantly be updated, and I need to be following these things closely, because if there's a problem in one of these areas, I probably don't want to do business with you. Okay? And any brokers who fail to meet these standards, they have to be removed. Okay? So that's the ultimate goal here. If you don't meet these requirements, I'm taking you off our list. We can't work with you anymore. And if they're off the list, there's no way somebody can work with them. Okay, so, and we make it clear that you have to trade with approved brokers that are on our list. Okay, so execution quality is also going to be monitored on an ongoing basis. You can't just look at one trade. It's a process. Okay, and then finally, trading records. They're going to have to be kept, and they're going to have to be used to address any client or regulatory concerns regarding any executions or trade allocations made by the manager to our clients. So again, documentation. I can't stress enough, you have to keep trading records. Now, many regulatory agencies allow electronic. I don't want to get into electronic versus paper and the rules and all of that, but you need to follow all applicable rules.